Trading a divergence is not that simple as it looks. And this trading concept is not for the faint-hearted. Not at all. Traders get excited seeing a divergence and trade the same. By and large, this results in their bank account to decrease. Well, there is no survey though in place backing my belief that more than 90% fail to earn out of this divergence, but unfortunately that is how it is. That's the very reason I categorize the same under advanced studies. No doubt this trading technique is one of the best ways to counter-trade the market. Making any indicator or a study to work effectively depends a lot on logics. And so is the case with divergence as well. It's all about thinking logically. If you had been trading divergences and failing, I guarantee you are going to do a lot better once we are through. So let's get going. A divergence serves as a warning that the trend is about to change. And this divergence occurs when the trend of a price doesn't agree with the trend of an indicator. Now, they are of two types: bullish or positive divergence and bearish or negative divergence. Now, in a bullish divergence scenario, price makes new lows, but indicator makes higher low. Market starts losing momentum to the downside, and the scenario suggests that prices may move higher. And in a bearish divergence scenario, price makes new high, but indicator makes lower high. Market loses momentum to the upside, and the scenario suggests that prices may move lower. Let's now understand this concept on a real chart. We have price information on this top panel, and this bottom panel we have 14 periods RSI. Now if you recall the sessions on indicators, quite a few had this divergence as a trading strategy. Now there are quite a few indicators that can be used to determine divergences: stochastic, RSI, MACD, CCI and ROC, to name a few. They all certainly do depict divergent scenarios, but RSI, which is Relative Strength Index, to me is undoubtedly best amongst the rest. Everything and any phenomenon has got a logic attached. All the indicators that I just mentioned on their day will throw best divergence for trading utility. But if I have to talk about reliability and consistency, then there is no better indicator than RSI. The question is now, why? Now, this divergence-based trading is a counter-trend trading strategy. We are looking to sell when market is in an uptrend and looking to buy when the trend is down. And for any market to reverse, it must get overheated. To define simply, it must get overbought or oversold. And you can have successful divergence trading only when trading such overheated scenarios. Indicators like MACD, ROC or CCI, they all are centered oscillators. They do not have any overbought oversold levels to read. Judgment is required to assess the same, as these indicators are not banded. On the contrary, indicators like RSI or stochastic are banded indicators. Such indicators have overbought oversold levels and obviously can be identified effortlessly. MACD is extremely popular when it comes to divergence trading, but the indicator doesn't have levels to identify extreme levels. So we must use banded oscillators for divergence trading. Now, of the two, that is stochastic and RSI, we will use RSI. The reason behind preferring RSI over stochastic is that the latter gets overbought or oversold quite easily and at times can be misleading. RSI, on the other hand, doesn't easily reach the extremes. Okay, so we have RSI here to trade divergences. Now for trading a divergence, the very first thing that you would be looking for is the divergent condition itself. We must have price making a new low and RSI making a higher low, or else price making a new high and RSI a lower high, obviously at the same time. Like this instance here, we have price making new highs and RSI has moved lower. So we have a bearish divergence here. Next is that RSI on the first instance must be overbought, and in case of a bullish divergence, it must be oversold. So here we have RSI shooting above this 70 mark. If this condition is not met, then forget about trading divergence and move forward. It isn't that trading divergences when RSI reading is below 70 cannot be profitable. It certainly can be, but I am talking about probability of success here. Probability of success trading such scenario is low. So we have a divergent scenario. We have RSI in overbought, and it's not important if RSI should be overbought here or not. Now this point is the most important one. Get this thing in your head. Price must close below preceding swing high, and then only the setup is complete, and you may consider taking a trade, otherwise just avoid. So I'll take you through the steps again. Number 1, look for divergence between price and RSI. Number 2, RSI must be overbought here, the first stop. Number 3, price must close below preceding high. Now let's go through another kind. We have price here making a new low and RSI makes a higher low. So it's a bullish divergence. Next we look into RSI readings, and yes, it's oversold over here, which is below 30. Now we must wait for the price to close above this swing low, and which it does over here. And this trade is good to go. One more point I would like to make, and is vital. More often than not, price tends to rest and test this very level before pushing higher. Look how price keeps coming to this line and then eventually triggers a rally. So, if you want to be even more safe trading divergences, then wait for this pullback before placing trades. But remember, it's not necessary that this pullback is going to occur all the time, and so you may miss out on potential trades. But yes, you will no doubt be safer. So this is how a divergence can be better traded. Probability of success trading this way will be higher. We are selling when the market is trending up like here. We have higher highs and higher lows. It's a firm trend, but we are looking to sell over here. This phase here we have lower lows and higher lows. It's a downtrend, but we are looking to buy. We are trading against the trend and must be very cautious. And you can improve trading divergences even further using volume information. Okay, so let's do this again. We have a gold chart here, and price is making new low and RSI makes a higher low. So it's a case of bullish divergence. Next, we look into RSI. The reading is oversold here, it's below 30, and now price must close above this swing low. It does the very next candle. And see here again, price throws back to this very level before pushing higher, this particular level. This act certainly cements the bullish view.